Hi there, good morning. My name is Victor Ali, and I'm the head of investment strategy at Sankore Global Investments. This is your weekly financial market updates. We start off in the US, where stocks closed mixed on Friday as concerns about a delayed Fed rate cut was subdued by blockbuster earnings from NVIDIA. On Friday, the Nasdaq rose to a record high as it added 1.1%. The S&P was up 0.7%, while the Dow was up just 1 basis point. For the week, the S&P added 3 basis points. The Nasdaq outperformed with a 1.41% gain, while the Dow slipped 2.33%, its first negative week in 5 weeks. After several strong economic data and job releases, the markets and traders are essentially now pricing in less than a 50% chance that the Fed would cut rates at its meeting in September. We saw stronger than expected PMI numbers. Composite PMI came in at 54.4 from a previous reading of 51. Manufacturing PMI came in at 50.9 from a previous reading of 50.0, while the services PMI also came in at 54.8 from a previous reading of 51.3. So clearly, this stronger than expected PMI is reflective of very, very resilient and expanding strong economic activity in the US economy. So this data point is pretty much suggesting that the economy is really strong and that, the Fed rate cuts would happen, later than most likely expected. So however, in spite of this, we saw the market, shrug off, the concerns around the Fed rate path on the back really of very, very strong, earnings from NVIDIA. We saw a, very, very strong surge in profits, 628%, while revenue grew by 268% for NVIDIA's fiscal Q1 results released last week. We saw EPS coming at $6.12, while sales grew to $26 billion, significantly surpassing analyst expectation. This record-breaking performance was really primarily driven by its AI-focused data center division, which generated about $22.6 billion, a 427% growth year on year. NVIDIA also announced a 10-for-1 stock split as well, essentially to increase or improve the availability of its stocks to investors. Today is a holiday in the US, Memorial Day holiday, which essentially heralds the beginning of the summer. So it's basically a holiday shortened week, going into the US markets this week. However, we expect the sentiment from last week to continue to hold sway. The market is really continuing to shrug off this, possibility that the Fed is going to have to hike, a little later than sooner. And this sentiment continues to shift as we see data points. So this week, we'll be looking at the PCE data coming through on Friday, which is essentially the Fed's preferred gauge for inflation. Again, we'll be looking to that data to get clues as to how that inflation picture is shaping up and what that is likely to do to the interest rate path for the Federal Reserve going forward. Last week in the UK, the Prime Minister Rishi Sunak called for snap general elections to hold on the 4th of July. This was somewhat surprising because, they still have up until January to have the election. So they're calling elections early. I think this is a sign really on the part of the Prime Minister and the Conservative Party that they are confident that they would, get re-elected. It's been 14 years of the Conservatives at helm, what can easily be described as a very bumpy 14 years, really, particularly so, over the last couple of years. Again, we'll see the outcome of that election. Campaigns have already started. The expectation really is that the Conservatives will hold on to power. But again, we'll look out to see if the dynamics will change in terms of the number of seats it wins in parliament and all of that. Over in Asia, it's going to be a very heavy data week. We have, PMI data for China is coming out this week. India is also set to release its GDP numbers as well, while Australia is set to announce inflation data. All of these would certainly prove very, very crucial in determining what happens really in the Asian market for the better part of this week. Over in Nigeria last week, we saw Q1 GDP data come out. Came in at 2.98%, 98%, which was higher than the 2.31 that we had seen in Q1 of 2023, but it was slower than the 3.46% that we had seen in the previous quarter. That's Q4 of 2023. Again, growth was primarily driven by the service sector, which grew by 4.32% and contributed about 58% to overall GDP. Also, last week we saw the Monetary Policy Committee hold its meeting, where it increased the monetary policy rate by 150 basis points, citing the need to, rein in inflation. We, however, saw very little reaction in the fixed income market to this decision. Again, the following day, there was a private market auction where, interestingly, the rates at the long end was dropped. The market had expected that with a 150 basis point hike, we were going to see a corresponding increase in the stock rates, but that didn't happen, and it left the market somewhat surprised. Again, sort of re-entrenching this divide, if you will, or the lack of a seamless synchronization between the fiscal and the monetary authorities. And true to that, there was an home auction on Friday, which was conducted by the Central Bank of Nigeria, where the rate at the long end was significantly increased by about 90 basis points. So again, it remains to be seen how the next primary market auction, which is conducted by DMO, what the outcome of that will really be. But at this point, it's really important that both the fiscal and monetary authorities really are in sync, and we are beginning to see cracks showing that they're not necessarily in sync at this point. So it remains to be seen how that the outcome of that next auction pans out, which is not happening until next week. We think that the market this week would largely be range bound. We don't expect any significant moves in the market. FAC came through last week, so that has significantly boosted system liquidity to about 117 billion. So the sort of selling that we had seen in previous weeks as a result of the very tight liquidity situation, we really don't expect to see that very heavily this week. So we expect that the market will likely remain calm for the better part of this week. That's pretty much our updates for the market last week and what we think we're likely to see this week. Thank you very much for your time. Do have a very, very productive week. Thank you.